to the private funding. The goal is not to turn you into fundraising experts, but to help you understanding the different phases, different type of investors, expectations, and so on. Okay. We will analyze 5 main chapters: what is private funding, funding stages, type of investors, the vehicles to receive this investment, and common questions and mistakes. So first of all, starting with what is private funding, you probably may know, but basically is when you receive capital that comes from private investors rather than public institutions or government grants. These investors provide money, but also provide, so they provide basically capital to grow, scale, and expand. But it's really important to take into account that in return, they expect a financial return of the investment. There are different types of private funding depending on the stage of the company. And unlike public grants, they are more market driven. So the investors assess risks, scalability, team quality, potential exits, and so on. It's typically faster than public funding, but usually involves giving up equity. That it's an important important point, and also taking structured financial obligations with the investors. So in short, private funding is about accelerating growth with external capital, but in exchange, you need to give them with some ownership or financial return. Why is important? Because as I was mentioning, accelerates growth. It allows you to enter usually new markets through these investors. Also, it's used most commonly for hiring key talent, and obviously it increases credibility because whenever you get an investment round, it's usually published in the news, and this way you get more visibility and access to future investment rounds also. But obviously it has some trade-offs because you need to share equity, control, and accountability of the company. Going directly to the funding stages. So we wanted to focus this training so to introduce you. Probably you know some of them, but a bit what are these funding stages? What are the type of investors that usually are getting in those stages, and so on. It usually goes from idea, so pre-seed, to validation, seed, traction, Series A, then scalability, that could be further series, and then market leaderships and exit. But these are not just levels. Each stage reflects a different level of maturity, different level of risks and expectations from the investors. And one of the biggest mistakes that funders usually do is approaching the right investor at the wrong stage. So you need to really take into account in which stage is your company or startup at the moment. Starting from pre-seed, so it's the earliest stage. It's basically going from an idea to an early validation. Usually it ranges between 25K and 500K, but this obviously depends on the sector and the geography. So it's different if you are based in the US, if you are based in China, or if you are based in Europe, and also inside of Europe, for instance, it depends also on in the country. The objectives of this stage is to validate the problem and define the solution. So basically to build an MVP and form the funding team of the company and achieve the first validation signals. The typical investors that we can see in this stage are founders, friends and family, business angels, and in some cases also accelerators and pre-seed funds. Here, what usually investors evaluate are the complementary skills of the team, the full-time commitment. This is an important key point. They don't want people that it's not fully committed to the project, and resilience. Also that the problem is real, that is painful, so there is an added value of the solution, and that is frequent. So the customer it's recurrently coming to pay us for this solution or service. And also early signals. So they want, even if you are not monetizing yet the solution, that you have done interviews with stakeholders, with early users, that you have letter of intent, you have tried to carry out some pilot users, some beta feedback from these first users, and so on. And obviously, the vision, the idea for an investor here is that there is a long-term potential and there is a large enough market to invest in. Then we would go to the next stage, that would be a seed. This just is not just about the idea, is to go from the validation that we were ending up in the last stage to product market fit. Product market fit is central here, and is the degree of a product that satisfies a strong market demand. So this is a key point for the investors at this stage. The idea is to launch the MVP and achieve this product market fit, acquire the first paying customers. So to achieve this product market fit, you should have some customers already interested in paying for the solution or the product or the service, and demonstrate some traction and growth potential. Typically, investors in this phase are angel investors, business angels, and angels syndicates. So several angels, business angels coming together to carry out an investment round. Also, early stage VCs and micro VCs, and seed-focused funds together with some accelerators. What investors evaluate in this stage is basically that the product is functional, so that you have a functional MVP and there is user evidence of the interest to this product. Also, the first signals of traction, so that there are some first revenues, that there is a growing user base or customer base, and there is an early retention of these customers. The market should be clear at this stage, and it should be demonstrated that there is a willingness to pay. So here already we need to validate the early monetization. So we need to make sure that we have the proof that someone is already paying us for the service or the product we are developing in this stage. And also the team, obviously, that is capable of scaling. And also here enters in place the hiring plan. So to make sure that we are planning properly the team that we need to hire to properly scale the solution or the company. Then we would go to Series A. This is from product market fit to scalable growth. It goes from 5 million euros to 20 million euros, but again, this depends on the sector and the geography where the solution is or the company is based. The objectives of this stage is to scale and validate the business model already, accelerate the customer acquisition, expand obviously the sales. So here is not only about validating the early monetization, is already to expanding these sales and making sure that there is a good number of customers that want to pay for this. So this is linked also to the marketing. So we need to obviously expand the marketing side of the company. And here enters into the game the operations part. So from this series to the next ones, we will see the operations is a key point. The investors look at this point because this operations part is the one that allows the market usually to scale, and it's really important. And then the idea is also to build a repeatable growth engine, so to make sure that this is scalable and it's exponential. It's not just a linear growth. The typical investors are the venture capitals and growth focused VC funds. Occasionally some corporate venture capitals, but it's more for later stages. And also worth to mention that business angels rarely lead an investment round at this stage. So they can join, but they don't usually lead these rounds, because obviously the amount it's much higher than in previous rounds. What investors evaluate here is the traction. So the traction is now key to make sure that the revenue growth and the clear user adoption and market demand is scalable, and it's always growing in a good size. The product market fit. So to make sure that we already validated this in the previous stage, but the idea is that we make sure that there is a low churn rate, meaning that the customers that we get in, they don't leave us and they come again to pay for our services during a specific time frame. Then a scalable model. So that we are able to scale this and that we have a predictable revenue model to make sure that we have some figures to justify and to take into account for this investment. And here also enters into it could enter before indeed, but in this phase is absolutely mandatory to have a good understanding of the unit economics, the metrics that the investors take into account, depending obviously on the type of product that we have. Is not the same on marketplace as a hardware component or SaaS. And the team. Always you will see that the team is important, and it's obviously an objective and logic reason. It's because the investors always take a look at the team, and they want to make sure that the team behind the solution it's able to grow according and aligned with the company growth. So here enters into place also a clear organization structure, also allowing to have a board of directors or important external stakeholders that could advise the company properly. Then we would go to the Series B and beyond. So basically, this is, I would say, one of the last biggest stages. It could be obviously more. We can have C, D, E, and so on, but we comprise them in a whole slide. So basically, this goes from scaling to market leadership. So it goes from 20 million euros to 100 million euros or more. And now with AI, we've seen that these rounds and these valuations have been increased in a crazy manner. So the investment rounds are getting much bigger, but this should be the range we have usually. The objectives is to accelerate the large scale growth, expand into new markets and geographies, and improve the operational efficiency. So here it's to make sure that the business is profitable, that is scalable. And yeah, it's basically more about operational efficiency rather than already the idea or the solution. The investors, what they want to fund here, it's basically companies that are getting the leadership of a market or for a market segment. The typical investors are the large venture capital funds, growth equity funds, and here enters into place, in most of the cases, the corporate venture capitals. Then also private equity and sovereign wealth funds, but these usually come in later stages. So when we are talking about the bigger figures of this stage. And what the investors value here or evaluate is the revenue growth. So basically to make sure that revenue growth is high, that it's sustained and the rates are good. Also the market positioning, as we were mentioning, the idea here is to take the leadership of the market. So for that, you should have a competitive advantage. You should have already a brand recognition, a customer expansion through different geographies and markets. Also, a really important point here is operational efficiency. So to improve as much as possible the margins and optimize also as much as possible the customer acquisition. And then that there is a clear roadmap and a strategic roadmap for the upcoming years in terms of making the business efficient, in terms of cost structure and so on. And also the governance. Obviously, as we go into the different phases, we are growing the business. And at this stage, we already need a huge governance for what it usually is a big company with an experienced management team, a strong board, and so on. So at Series B and beyond, the goal is not longer to prove the model. It's to make it efficient and to win the market, basically. And then it comes the exit. So after all these runs that we have seen, investors, we need to have clear that that funders, funders need to understand that investors are not investing for dividends or small returns. They invest for exits. So they are looking for the exits. The venture capitals, for instance, works with a portfolio. So they invest in a portfolio of diverse companies. They know that some of them will fail, but what they are looking for is for the exit of some of those companies that usually they look for 10 times the initial investment or more in return when they have an exit. This exit means that the investors or even the founders sell their shares and their equity of the company for a financial return. The most common one is the M&A, so basically the acquisition from that is, for instance, a company that is bought by a large company or by a strategic competitor or by a private equity firm. So basically, someone comes to us and says, "I'm in the same sector. I would like to buy your company, your shares." Then also there is the possibility of an IPO, so basically to go public, to go into the stock exchange. So this is when you are a really huge company with a really good customer base and so on, that you can go into the market and you can sell these shares into the market. So anyone in the public market can buy your shares. So this means that not only the investors but also the funders can sell their shares here. And then secondary sales, that this is basically that the investors that have invested in previous rounds, they sell their shares to the other investors that are coming in later stages before the full exit of the company happens. So this was the chapter about the funding stages. So the idea with this is to give you an idea of the different stages that are taking place in the private funding environment. But the most important thing here is that to take into account, because funders sometimes do not take this into account, is that private investors do not invest only in companies. They invest in future exits. What they want is financial return at the end. So this is a really important point that should be clear for all. And now let's go to the type of investors, because we've been talking about type of investors in the previous slides. You might probably know the different types, but to go a bit more into detail, specifically on who they are, what they bring to the company, what they look for, which are the advantages and challenges for each of them. So this is the 8 investors that we will analyze in the next slides. There is if you see the graphic of the figure, this is a typical figure that you may have seen in other, if you take a look at private investment articles and so on. It's basically how the journey of a startup evolves in terms of the private funding, in case that is really successful and it comes from the idea to the exit or the potential IPO. So it's yet supporting material, but what I don't like it is that it's one of the most common mistakes also in the beginning, that is the 50-50 share from the founders in the case they are two. Also a common mistake that shouldn't happen, because obviously whenever there is a conflict between the two founders, it's the company is blocked basically. So but it's a good figure that summarizes the journey of this private funding. Going into the into the type of investors. The ones that we all know are the founders, friends, and family. So basically, usually how the most startups begin is that the founders themselves put their own money to basically start running the company. This is known as bootstrapping, but basically simply means that the company is funded with your own resources of the founders. This could be through personal savings, revenues, personal loans, whatever. The good thing of this is obviously, and is the most common way, because you own the whole shares of the company and you have the full control of it. Obviously, the challenges here is that usually not all the people has the enough capital to build this its own company, and this is it gives the founders with a higher personal risks. Then there is the friends family. We could include the fools here, but usually it's friends and family, the people that we have that are close to us. They trust us, so basically they provide us with some more capital to start the business. This gives you quick access to capital, but it's also some difficult thing to manage, because it could lead also to personal conflicts if expectations are unclear, or the terms are not clear. So it's better always to have it in writing, in a contract form, in order to that everyone has clear what are the expectations of the capital that is provided by people close to the funders. Then we have crowdfunding. It's maybe an old-fashioned method, but it still works for some companies. There are several types. For equity, basically, is the same. They paid allows to startups to raise capital from a large number of people that you don't know, through probably most commonly from online platforms. Basically, there is equity based that they pay you for some shares of the company. These are reward based, that basically they pay you for giving them afterwards some rewards or products. So they are not asking for shares here. And there is donation based, that it's basically that they don't expect any financial return for the capital that they are putting for the company. These are some of the platforms that are commonly used for this purpose. And the advantages of this is that you can have access to a huge base of small investors, that you can validate the market quite quickly, and you can get visibility, and that builds the company in an early community. So at the end, it allows you to set up a good base of customers and early users, even before you launch the product. The challenge is obviously time consuming, because you need to do a lot of marketing and campaigns, and there is a public exposure of the idea. So if it's not working, it could lead to bad feedback and so on. That is not suitable, obviously, for all the models. As I said, could be an old-fashioned, but it's still in place for the companies to be used. Then we go to angel investors, or business angels, that are the most common profile when we are talking about early stage companies. Angel investors or business angels are usually the first professional investors that startups interact with. They invest their own capital, and they often bring valuable experience for entrepreneurship or industry leadership. Obviously, they usually invest in the pre-seed or seed stages, when the company is still validating its product and early market traction. Also because the investment ticket is lower, and taking into account that they are putting their own resources in this. What they bring is early capital and validation, industry expertise and mentoring, and network access and strategic support. So they are also really valuable in terms of if we will look also for future rounds, they have the right contacts usually and right networks to provide you with these future investment rounds, and also industry contacts in order to have partnerships and so on. What they look for is an strong funding team, that there is a clear problem and market opportunity, and there is a high growth potential. But this is a common aspect for all the investors. The advantages is that usually they are faster and more flexible. They have, as we were saying before, valuable industry connections, but there are some challenges, and it's that they obviously have a limited investment capacity versus venture capitals or other type of investors. And also that if we get into the cap table, so basically the people that owns shares for the company, a lot of business angels, then the cap table could become quite complex. How to reach them? So usually the best way is warm introduction. So founders of other startups that have been previously funded through this type of investors. The best way is to contact with them, and they will introduce you to these contacts. And also really useful is that there are almost always national business angel networks, at least in Europe, and also sectorial business angel networks in some cases. Then regarding venture capital, so venture capital goes usually from C to Series A and Series B. It goes from 500K to 10 million euros. Here, when we talk about venture capital firms, we need to take into account that we are talking already with professional companies that their business is to invest in it. So what they bring is significant raw capital and strategic guidance in terms of different aspects of the company. They also they provide you with global networks and scaling support, because their interest obviously is that that the company scales for a future exit. What they look for is a large scalable market and a strong traction already and growth metrics. So they don't invest in an idea. I would say never. And they expect a high return potential. So 10 times the investment that they put it at the beginning. The advantage is the access to large amounts of capital, strategic support, and future investment rounds. And the challenge is that the due diligence comes in. So this process that it's really burden process that you need to go through with them in terms of providing them with all the documentation, the contracts, and so on. It's a process that takes long, and it needs a huge effort from the startup side. And also that they can control, and they will push you for a growth focus rather than sometimes more organic and sustainable growth of the company. How to reach them? Again, the usual thing is the best thing indeed is the warm introductions from other founders or startups that have been already funded by those venture capital funds. But also there are some platforms where you can find some of the venture capital funds that are investing and the different sectors and so on. And also the events. I didn't mention it for business angels, but the events are a really good opportunity to have one-to-one chat or discussion with this type of investors. So take this also into account. Then it comes the corporate venture capital. So basically, this is it's a venture capital, but it's a company itself. So imagine Google or I don't know, Mercedes, a big company. They usually have their units dedicated to investment. So they buy smaller companies and startups that are aligned with their sector, with their interests. What they bring in is a strategic industry expertise. So imagine if you get an investor from a company like this. Obviously, you will have huge industry expertise that they can provide you with, customer access because they already have the customers paying for these services, and the distribution channels. So it's a really strategic partnership, not only from the side of the capital, that obviously it is, but also from the operational perspective of a company. What they look for, it's basically a strategic alignment with the industry. Obviously, they don't buy companies that are out of their scope. That's logic. But they look usually for complementary technologies, something that they don't have, or something that they are seeing it in the market, and it's better to basically invest in and or buy it rather than start developing from scratch. And what they usually look for is long-term collaboration potential. This is different from the VCs that they want exit. This is not the only motive why corporate venture capital will invest in a startup. The advantage is that, as I said, they give you access to networks and markets. They provide with strategic partnerships and pilots, so this is key, and also with industry credibility. Imagine that one of these huge companies invest in a small startup, the visibility and credibility of this startup increases a lot. The challenge is, it's true that a strategic interest of this corporate may influence decisions according to their interests. So it could bring also possible conflicts with competitors. And it takes usually longer decision-making processes because we are talking obviously about large corporations, usually huge companies that they have already lot of layers in terms of decision making, so it takes usually long in the process. And then we have the family offices. Family offices are basically private investment organizations that are that basically manage the wealth of affluent families. So families with huge capital that they want to invest in different businesses. Here we are obviously focusing on early stage startups, but these family offices don't manage just investment to startups. They manage also investments to real estate and other verticals. What they bring in is flexible and patient capital, so they are not they don't push as the venture capitals usually. They want an exit, but they are not that they don't look for those limited time frames. Also, they provide with strategic advice and business networks because they are usually well connected. What they look for is a strong and trustworthy funding team and a sustainable business model, obviously. But the main point here is that they want some long-term value creation. So here is not only about the exit, that obviously it's an important point, but it's also about the value creation that this company could create in the future. Because sometimes they don't look only for the exit, they look also for the having shares of those companies, and not sell them basically. Advantages is that they have greater flexibility, they have a longer term perspective rather than versus the venture capitals, and they are much faster in the decision making process. They don't need to go through all those layers as the corporate venture capitals or venture capitals. The challenge is that is a usually less structured investment process, that the investment strategies can vary widely. So meaning that they can invest in different sectors, in different technologies, and the strategy is not a common one as for instance, venture capital. And sometimes it could happen that they have some limited experience. For instance, if the family office is quite new, or if they are investing in something that is not from the same sector where they have experience, and so on. How to reach them? Again, I would say that for most part of the investors, the warm introductions is the way that works better. But it also usually works with VC co-investment rounds. So we need to take into account that the venture capital funds are basically companies managing funds from other stakeholders. So usually within these funds, there are already family offices in, but also sometimes these VCs contact the family offices to take into account in case they want to take part also in an investment round apart from the VC. And also the investor events. The family offices, the people that manage these family offices are also really common in the main investor events around Europe and worldwide. And then last but not least, the private equity firms. So private equity firms is a bit different. They are basically investment funds that invest in more mature companies rather than early stage startups. These some examples could be CVC, Blackstone, and so on. Their focus is usually on companies that already generate huge revenues and have established business models. Um, and they provide obviously with a larger capital amounts. So they focus in later stage and pre-IPO. What they bring is large capital, operational and financial expertise, strategic restructuring capabilities. So they usually also look for companies that are with large revenues or with an established business model, but also where they see the possibility to implement restructuring or also to improve the operational efficiency of the company. They usually also what they are really used to prepare IPOs, so they bring in also all that expertise in case the company is looking for an IPO. Um, and what they look for is those established business models with revenues, opportunity for operational improvement, and a clear path to an exit. Advantages. Obviously, they provide with substantial capital, but the main point here is that they have a huge expertise in scaling operations and improving efficiency of already established companies. Um, so that's the main support that they would provide. The challenge is that they have a strong focus on financial performance. That's why the operational efficiency it's their key point here, and also that they require a huge governance and control in terms of the investment they put in the company. The trade-off is that they want usually to control or have a control of the company. And also, this is not the main focus here of this training because it's less suitable for early startup. Sorry, it's as I said for already mature companies. And those are the main type of investors. And now let's go through the investment vehicles because this is another important point. We usually only think about equity shares, but there are other ways to fund the startup. So the investors can provide capital to startups through different structures. This is known as investment vehicles. The most common one, as I was saying, is equity. In this case, what the investors receive are shares of the company in exchange of their capital. Um, but it's not the only option. There are also another three main options, I would say, that are, for instance, the convertible notes. That is basically loans that convert into shares if the company goes through a funding, private investment funding round in the future. Um, so this is often used when early valuation is uncertain. So it's difficult to evaluate um, how much should I put from my investment to receive, for instance, an X% of the company shares. So this is focused also in early stage. We have also the simple agreement for future equity, SAFE. Basically, it allows to investors to receive shares in a future round without the complexity of the debt terms. So it's basically converts the investment in a next round, and it's faster and more simple than convertible notes. So they are repaid, let's say, when there is a next round of investment. And then there is the revenue-based financing. So here, instead of receiving the shares of the company, what they receive is a percentage of the revenues of the company in the future. So there is no equity dilution here. Obviously, it's a good option, but it should be for startups already generating income, because otherwise it's difficult to justify this type of investment vehicle. And those are the four main investment vehicles. Then we can have obviously the public ones, the grants, and so on, or the debt itself. But these are the four most common ones that could be used in the early stage startup funding. And then last chapter, before we go with the Q&A, in case you have any question. Here I wanted to make it a bit more operational, let's say, and go through some common mistakes and questions. I think this is a useful resource. Let's go first with the common mistakes. These are, I think, valuable insights for the people that doesn't know a lot about private funding and wants to explore this possibility. The first one is try to raise money too early. So basically try to seek for an investment without traction. Before, years ago, I would say that it was easier to get funding or private investment just with an idea, with a PowerPoint, but it's getting even more and more difficult nowadays. So you need to demonstrate usually tractions, and to take into account that investors have long memories. So if the investor says you, come back when you have this, if you come back with that years after, they have good memory, and they will continue the discussion. But don't go to an investor and try to get an investment too early if you don't have the traction or the product validated for the stage you are in, because that can damage your reputation for the future and for future investment rounds. Then another really common mistake is the inflated valuation. So asking for a 5 million valuation pre-money, just because the 2K monthly recurring revenue, because the market is huge, just with a theory, let's say, but not with facts. It's an immediate no, obviously, for investors. So it's really important to take into account the valuation. There are several valuation methods to calculate the valuation of your startup, but this is really important, because the figure you set up when you do this calculation is the figure according to which you will receive the investments and the equity that you will give to these investors. So the valuation should be taken really into account and really carefully, and no just saying I have 5 million euros of valuation because I think there is a huge market without just with a theory and assumption that it has no facts behind it. It's also really good here to, when you do this calculation or valuation, to look at other exits and other investment rounds, no exits, sorry, other investment rounds for this similar startups in the sector, in more or less similar geographic scope. Also to look at different platforms such as Crunchbase, Dealroom, and so on, because there you can get info about this. But please take into account this when you do the valuation of the startup. Also, generic mass pitching, it's a common mistake. Just prepare a pitch and sending it to hundreds of investors with a generic email. This usually gets a 0% of response rate. Obviously, you need to personalize the email. You need to take into account that they need to be confident in order to invest in your company. So it should be a personal relationship, and so that's why the warm intros are really important. And you need to understand what that investor invests invests in. Basically, you need to search for the sector they are investing, the stages, the ticket size, and so on. So please do this desk research before contacting an investor with a generic pitching. Also important, not understanding the term sheet. So the term sheet, basically the contract with the investor. Um, uh, it's really important to take it into account and, if possible, contract a specialized lawyer, because what it seems, Klaus, that you sign it because you want the money and that's it in an early stage, it could become it could become million of euros in the future. So it's better to get the specialized support here, spend some money, but make sure that the term sheet is clear for the startup, because taking into account that the investors are really experienced in this, and they have all the experience they need to prepare their term sheets, that they are more advantage for them. Then also, two more common mistakes is the endless fundraising. So a company that's it's been looking for raising funds for instance, 1 year. That's a major red flag, because this means that has not raised the interest of enough investors, and this means that at the end, if it doesn't raise the proper interest from investors, I don't think that in future you will get another one that will not question, let's say, the why you are not receiving that interest before. So the usual time frame is to set up a 3 to 6 month late deadline, sorry, and to create FOMO, fear of missing out, basically, so that the investor is interested in getting in as soon as possible, because otherwise they can be out of that round and lose the opportunity. For that, it's obviously useful to contact and engage with different investors and different types, if possible. But obviously, what we mentioned before, with a personalized approach, and establishing a personal relationship with them. Then ignoring runway. Really important also. Take into account that if you run out of cash of the company during the investment, trying to raise an investment round, you will be in extremely weak negotiation position, because at the end they will see that you don't have the proper or you don't have enough cash to continue with the company, and then the valuation can be lower and the conditions can be much worse than if you are in a good position in terms of cash flow. So the usual tip is to start fundraising with at least 9 months of runway. If you are less than 6 months of runway, meaning that you cannot stay more than 6 months without an investment, rethink and try to grow organically rather than looking for an investment round. And then common questions, also important. For instance, how much equity should I give per round? So these is not written in stone, but these are common figures that are shared and that are suggested, let's say. The idea is that the founders should, or they need to try to get more than a 50% after Series A. It's common that after Series B, you would only be at 30-40%, but for Series C, try to be with 50% of the ownership of the company, because otherwise, if you don't control your company, at the end you will lost also the interest on it, and you will feel that it's controlled by someone else. These are some common figures. So at pre-seed, the common shares to be delivered to investors are between 10 and 20%. In seed, between 15 to 25%. In Series A, between 20 and 30, and and Series B and beyond, 15 or 25% of the shares. Also, how long should take to close a round? As we were saying before, the time frame of a round is really important. The endless fundraising is a major mistake, and you should set clear deadlines for this. Um, but usually take into account that could take 50% more of time than the time you expected, because always things take longer than you expect. With angels, it's common between 1 to 3 months. With seed BCs, is from 3 to 6 months. In Series A, could take from 4 to 9 months, and when you go public, obviously with an specialized company or lawyer supporting you, it could go from 2 to 6 months. Some other common questions. Can I raise without revenue? Yes, you can, but at lower valuations, obviously. It's common in pre-seed, so it's viable because at the end in pre-seed you are validating your business model and the idea, basically. Then if we go further, so if we go to seed, it's difficult because in seed you should already validate the yearly monetization. And beyond that, Series A, it's obviously impossible to um, to get an investment without revenue, excepting for some sectors like biotech or deep tech, if they see that the opportunity could be huge in the future. And this is something that we are seeing, for instance, with AI nowadays. Um, if you don't have revenues, make sure that the team is strong, that you have an added value, a differentiation to the competitors, and there is a large market. And if possible, have letter of intent, pilots, whatever you can have to support that investment. Also, a common question: equity of debt. Obviously, it's obviously much better debt rather than equity, because in equity you are losing ownership of the company, but it's not for all the stages. For instance, for pre-seed and seed, you don't have revenues, so there is no cash flow to repay that debt. So you should, or the most common thing is go for equity, because the banks will not provide you with usually with this debt at this stage. Post-seed with revenue, you can combine both, so you can have equity and you can have debt to minimize the dilution of the ownership of the company. And then after Series B, you can have venture debt to complement the equity, but always take into account that that debt in some cases is risky if you don't have the monthly recurring revenue that you need to pay that debt in the upcoming months or years. And last, is my valuation correct? As I would say, I will start with the other one. Do I need a lawyer? I would say that for seed or Series A, obviously from seed onwards, you will always need a specialized lawyer. As I said before, if you don't prepare a good term sheet with the investor, something that could look at as a small amount, it could be a huge control of the company or millions in a future exit. So it's important to have someone that perfectly knows how this works. For the first stages, so pre-seed, for instance, where you engage with friends, family, or fools or funders, it's good to you can use templates. If you have someone that can help and knows about the how this works, the better. But if not, you can use templates. But you should have clear contracts within these first early investors. And I wanted to finish with the if my valuation is correct, because I think that at the end, almost everything ends into this. Because the number that you give to your company pre-money before you get the investment, that valuation is at the end the figure that defines if you give 20% of the company, how much should be that investment. So it's really important to be really careful here to calculate it properly. There are several methods that you can you want more information, we can share with you, but there are several methods that you can use for this, also according to the different stages. But usually for early stage startups, it's really useful to compare with other companies and startups that have received an investment round recently, to compare the sector, the geography, and so on. Then there are the methods like a scorecard, that you basically give some scores to the different segments of your business. The PC method, so basically to calculate and to see how are the metrics going, and which should be the evaluation according to those metrics. And also do desk research with platforms, as mentioned before, with their deal room, Crunchbase, and so on, to make sure that you have also benchmarking in the sector. So it's better to raise at Arena's reasonable valuation than fail by asking for a huge valuation that is not real and is not aligned with the position of your startup at the right moment. And that was all. So as I said, this is the first introduction to the private funding. I hope it helped clarifying which are the stages, which are the type of investors, the investment vehicles, and which are some of the most common mistakes and questions that come up during these investment rounds exploration.